Welcome, everybody. This is one of our many webinars that we've been doing this past year. We've gotten great feedback from clients knowing that they can dial in instead of having to make it to a physical location. They can jump in on a webinar, whether they're down the street or they're halfway around the world. It gives people an opportunity to hear from us, hear what we are thinking about and hearing about. One of the things that we know for sure is that the media is really negative. And so we try to be a competitor against the media in that they have done numerous studies on this, and the ratio of negative to positive news stories is 17-1, which is pretty amazing. If you can just imagine if that's what you pay attention to all the time, you probably think that the world is a very bleak place. So we want to be an antidote to that. We want to be able to help you not only understand the world around you, but understand how that pertains to your wealth and to decisions that you'll be making. I'll pop up and talk to you here now and then. You can see me, I'm here at my desk at Keystone Financial. And today the title of the presentation is The True Cost of Investing, but other topics I'm going to sprinkle in because it's such a hot topic right now is the Fiduciary Standard. You've probably heard that thrown around in the media over the past year. There will be a brief discussion on where that came from or where it sits right now as far as what type of legislation or regulatory action is being thrown around with the Fiduciary Standard. So we'll talk about that. We'll also talk about the true cost of investing, and the word true in there is pretty important because a lot of people don't understand that the fees that you don't see oftentimes are bigger than the fees that you do see. So it's very important to understand not only what the cost is of investing, but what value you're getting from them. So that's going to be our discussion today. Certainly want to be able to interact with you. If you can see the questions box, again, feel free to ask questions as we go. It'll be more fun if we do that. And certainly if you are able to dial in to that, that'll give us a chance to interact back and forth and not have me just talking at you. But I will tell you that the stuff that I'm sharing with you, it's the questions people are asking all the time. When we have community members out there, when we're talking to prospective clients, when we're talking to existing clients, a lot of questions tend to come up over and over again. So we're definitely going to be answering those as we go. And hopefully in about 30 minutes, we'll be able to get through what I thought that you'd want to hear about, and then we can open it up to questions at the end. So I'll shut myself off for right now just so you can see our slides, but I'll be back here in a bit. So the true cost of investing, fee transparency, really our industry has been terrible at this over the years in that typically people had no idea what they were paying for. In fact, in a lot of cases, people didn't even know that they were paying something, which doesn't really make sense. In this world, there's not really anything that you get for free. There's always going to be some cost to it. So it's interesting having those discussions with my kids. They are now 14, 12, 9, and 7, and sometimes they'll say, oh, that's free. And then we get into that discussion, is it really free or is it just the appearance of being free? So the reality is there's a cost to everything, there's trade-offs to everything, and we're going to talk about that as we go. The one thing I did want to hit here at the beginning is that the agenda today is a few different things, but before we get to that, the Fiduciary Standard. Number one, though, today we're going to be talking about what you're paying for and why, and how that relates to fiduciary. Number two, the correlation between investment value, performance, and expenses. There definitely is a correlation there, so that's important to know. And then number three, questions to ask your advisor or financial services provider. And I realize that some of you are current clients. That pertains to myself and Keystone Financial Services just as much as anybody else. So there should be no question that you don't feel like you can ask. We want to make sure that things are very transparent and that you understand exactly what it is that you are paying for, what you're getting, exactly what the costs are, where you would see that. That's really important that everybody know that. Now, at the end of the day, you could be paying a lot and getting little at a firm, or you could be paying a little and getting a lot. So it's important to understand exactly where you would be able to judge that for yourself. About a year ago right now, the Department of Labor, this was still under President Obama, the Department of Labor put out some new regulations that were highly anticipated, and they were about creating a fiduciary standard for financial advisors. One thing that you might not be aware of is that there are over 300,000 of us in the country, and by us I mean people that would call themselves some variation of the term financial advisor. So common terms would be financial consultant, financial advisor, financial planner, wealth advisor. Any of these would tend to pertain to the same type of person in that they're giving advice related to your investments and your financial planning. So there's over 300,000 people that have some variation of financial advisor in their job title, but way less than half of those people are considered a fiduciary. That's pretty important to recognize because the fiduciary standard means that the person you're getting advice from is legally bound to giving you advice that's in your best interest first and to be disclosing any conflicts of interest. So a lot of times I tell that to people and they say, well, duh, isn't that what I'm paying for? Isn't that why I would go to a financial advisor? But the reality is that most financial advisors are not required to adhere to that standard. So you may not be getting advice that's in your best interest. It could actually be better for the firm, the company that you're working with, than for us. You can see a couple more people joined, by the way, Gene and Joe. Thanks for joining us today. I can see, oh, good. Alan says that you can ask questions now, so that's good. Glad that you're able to interact. Again, this makes it more fun along the way. But yeah, again, less than half of the financial advisors are considered fiduciaries up until now. Now, this April, like right now, in other words, that rule was supposed to have taken effect. And so what the Department of Labor was doing is giving financial services firms a year. If they weren't in compliance with that fiduciary standard, it would give them a year to do that. And now that April's rolled around, President Trump actually has put a hold on that, a 60-day hold to evaluate that rule. And I think what's happening is that not that that's going to be completely nixed, but I think that there'll probably be adjustments to it. And there'll be some consideration to investors that might actually end up paying more because of the change in the standard. So that's not what they were aiming for. I don't think last year when they put that into place, they were hoping to put consumers in a better position, not in a worse position. So there probably are going to be some adjustments to it. One thing that you should be aware of is that we've always been a fiduciary firm. Since 2010, when Keystone Financial started up, we have always been a fiduciary firm. I've been a certified financial planner since 2005, and when you're a CFP, this is to answer Luke's question at the beginning, how do you know if your advisor is a fiduciary? If you're a CFP, a certified financial planner professional, you are automatically considered a fiduciary, so there's no avoiding it. I don't think there's any use in avoiding it anyway. Personally, I like it that I'm a fiduciary. I like it that my clients know that we're bound by that standard because it is the highest standard in our industry. So time will tell. We'll see what ends up happening. There are various entities that could be vying with their own versions of this rule. The current Department of Labor, of course, could make adjustments to it. It could be that the Securities and Exchange Commission will issue their own set of rules, or it could be Congress. Maybe it's some type of legislation that gets put into place. But bottom line is, it's a good thing. Really, it's a good thing to have a fiduciary standard where investors know that whoever they're working with, they're bound by that standard. It would be kind of like going into a doctor and not going into the doctor and not knowing if they were going to give you medical advice that was in your best interest. That's just crazy. But the reality is people think that that's what they're getting regardless of what advisor they sit down with. So just rest assured, with us, you are working with fiduciary advisors, and that's really, really important to us, and we're very proud of that. So jumping into what you're paying for and why, cost of investing today. Fee transparency is one thing that we've worked really hard on over this past year, and it's never been an issue of not wanting to disclose costs or fees or anything like that, but having the technology to be able to do that is not always the easiest. So we've worked on that over the years and tried to find different ways to be able to illustrate that to clients, to make that available. But one thing that we've put into place about 12 months ago right now is a new piece of technology that we had built for us that we call the Client Experience Optimizer. And the Client Experience Optimizer not only shows you where your investments are, but it shows you exactly what you're paying. And it shows you exactly where your money is invested with all expenses included. And as we get through the presentation, it'll make a lot more sense to be able to see all your costs as opposed to just certain costs. So it's important to be looking at fee transparency as a standard. Really, it should be something that you just expect as a consumer, not something that you have to wonder about how much am I paying, or maybe there's some hidden costs that I'm not seeing. But it's important that you're able to have that transparency, to be able to see where all of it is, and not just the fees that you're paying to the advisory firm, but for the cost of the actual investment vehicles themselves. So let's take a look at that. We'll break it down because it can be a little bit confusing. Mutual funds were a vehicle that we used a lot in years past, and we really have gotten away from mutual funds because it wasn't always easy for us to determine, or the client to determine, what the real cost of investing in those funds was. Traditionally, they've been a great vehicle from diversification standpoint, getting professional management, but one thing that they've struggled with is to make it very clear to investors what it is that they're actually paying. So we really have transitioned out of a lot of our mutual fund holdings simply so we can show everything, and there's no question to us or to the client as far as how much that is. So the underlying expenses of a fund are not going to show up on a statement. That's the bottom line, is that you're not going to see it as a line item where it shows you how much those costs are. Mutual fund operating expenses. Some people look at this list and they say, wow, I can't believe this. But the reality is that mutual funds have the whole power structure of expenses that get layered in, and not all of these show up in a prospectus. Some of these things get buried in other types of disclosures, or that they're just not even required to disclose some of the fees. The big one here, I think, is trading fees. Trading fees can be very expensive and can exacerbate whatever a fund's stated expense ratio is. But the different types of expenses I'll go through quickly. Front-end sales loads, some mutual funds still have those. That's not as common anymore, but it means it's a sales charge. Basically, it's a commission when you buy the fund. Number two would be back-end loads or contingent sales charges. That would be when a product, for example, an annuity, has a fee to get out, if there's some type of a cost to get out within a certain amount of time. Redemption fees, exchange fees, account maintenance fees, these all add up over time. And so almost always, as Luke and I have gone through and done research on a number of different funds, their real expense ratio ends up being much higher than their stated expense ratio, what they're legally required to disclose. So just be aware of that. There are a lot of expenses that none of these would show up. You know, the thing is none of these would actually show up on the statement, and they're real expenses that would cause you to have less of a return. Exchange-traded funds are a vehicle that we like a lot, actually, because they allow for a lot more transparency. First of all, they're extremely inexpensive, much, much less than an average mutual fund, and some are as low as 0.05%. I think there are several companies that now offer the S&P 500 exchange-traded fund that is next to nothing for expense. So there can be expenses that come into the trading activity, and that, again, does not necessarily show up in a rate of return expense ratio that you would see. For example, when you buy and sell, there's always going to be some cost to trading those exchange-traded funds. If there's trading costs within the fund, which there are, because a fund is buying different stuff, right? They're buying Apple and Walmart and all kinds of different stocks within that. They have trading expenses to go out to the exchange and buy those securities. So it's important to know that exchange-traded funds, while they're much less expensive than mutual funds, they still do have a cost. Annuities basically are kind of a hybrid investment where there are investments that are inside the annuity products, but annuity is issued by an insurance company, and typically why you would buy an annuity is because they're making some kind of a guarantee to you. Usually it's a guarantee of income over a certain amount of time, or maybe even your lifetime. But there's a cost of investing in an annuity for that, because now you're not just paying investment expenses, you're paying insurance expenses as well. Are annuities a bad thing? Not necessarily. I think a lot of cases people don't know what they have, so oftentimes we'll end up with a client or a prospective client that comes in, they show us their statements. In fact, I had one recently where somebody showed me a statement. We went through, we figured out what all the expenses were on this product that had been sold to him at another firm. And it turned out that he was paying almost 4% annually to have both of the investment expenses and the insurance expenses layered in. But what was really disturbing is the fact that we talked about what he was getting, and it was a lifetime stream of income that was guaranteed to him, which sounds good, right? It sounds good to have that, but he didn't care about that. That wasn't even a feature that was important to him, so he was paying this huge expense for something that really wasn't any value to him. So it's important to understand what exactly that guarantee is and if it's something that you even need, because it can be very, very high expense and can make it very difficult to actually get any growth out of that type of product. So annuity fees, mortality and expense risk charges, those are typically 1.25% per year. Basically, it's insurance expenses, it's administrative expenses. There are other administrative fees that oftentimes can get added on top of that. So oftentimes you'll see that as a line item on your statement. And then on top of that, again, you have the investment expenses. If you own different funds, mutual funds, exchange-traded funds, the vehicles that we mentioned before, those would be on top of the insurance expenses. So knowing that you may not be seeing any of this, it's important to know if you have an annuity, what exactly are they charging, and if you're okay with that, if there's enough value to justify that. Annuities, I would say as a category, though, are oftentimes owned by people that don't necessarily need that product. I'll be nice about it and say that they're oftentimes oversold. And then a couple other things, penalties, fees and charges for other features, again, making sure that you need that. Sometimes there can be a long-term care benefit or some type of a death benefit that's in the contract. Again, making sure that you understand the cost for those and if it's something that you actually want. Real estate investment trusts, these are a vehicle that we've used on and off over the years, can be a very good way to get real estate exposure without you having to go out and buy properties on your own. Sometimes people enjoy doing that, and that's fine, but oftentimes it turns into a part-time job, and there's also risks that are associated with it. For example, if you had rental property, I've heard horror stories, and I'm sure you have too, as far as tenants that trash the place or start a meth lab in the basement, and then it ends up being massive expenses to rehabilitate the property. Meanwhile, there's no rent that's being collected during that time. So there's a pain in the butt factor and there's a risk factor with owning those properties. But sometimes real estate can be a very good investment and a very good diversifier against the rest of the portfolio. Just like any kind of real estate investment trusts are a way that, first of all, you can get immediate diversification because you would tend to own a lot of properties that are professionally managed. But just like normal real estate, they're not liquid. You're not going to be able to just go out and hit a button like you could with your stocks or your exchange-traded funds. So you don't have as much liquidity. We're pretty careful when we do invest in real estate trusts. We're careful about how much we're putting in because we want to make sure that people have plenty of liquid assets. The real estate can be a very good income generator and also can be something that will hopefully zig when the rest of the market zags, providing some good diversification. Inside real estate trusts, you can buy real estate mutual funds that can have expenses, or you can buy them as non-traded real estate that are private real estate holdings. So those can be more beneficial sometimes from an income standpoint, give up some liquidity, and you give up some certainty as far as when your money, your capital will be accessible, but it can result in a much higher amount of rent effectively that you're collecting, typically paid out monthly or quarterly. So looking at all these different types of vehicles, exchange-traded funds, mutual funds, annuities, real estate trusts, it's not to say that any of these are good or bad, but I can tell you that they can all be good or bad based off of the situation with the client. Annuities are not necessarily always a bad investment, but I've seen plenty of situations where they can be. Same thing with real estate trusts, mutual funds, and exchange-traded funds. We need to make sure we know exactly what it is that we own and exactly what we're paying. Risks, there can be risks with all of them. I think we could write books on that, but there is no guaranteed investment. Even an annuity which offers guarantees from the insurance company, as we know back from 2008, 2009, were there insurance companies that went out of business or effectively went out of business but were bailed out by the government? Absolutely. So there is no free lunch here. There's always going to be risks with any investment that you purchase. So looking at your options, let's take a look at other things that you could do here. besides just investing on your own. Robo Advisors would be a newer vehicle that essentially is for people who really don't care about any kind of a direct relationship with an advisor. In other words, the appeal of having somebody that they work with directly that knows their family, their situation, they might say, you know what, that's not important to me. I just need some type of platform to go online myself that would provide some guidance, but it would be technological guidance for where I should put my money. So robo-advisors are one area that has become relatively new. It's interesting, there have been news reports on this that sometimes even though robo recommendations might be made, oftentimes consumers aren't making those, and they're not making those action steps, in other words, to take those recommendations. So that's a lot of value that I think we add right there, is that, in fact, our mission statement is that we bridge the gap between knowing and doing in the financial lives of our clients. So that's pretty key, is not just knowing what to do, but taking action on it. And sometimes it's not taking action, because there's a temptation always is to pay attention to the news media, paying attention to CNBC or whatever mode of media you like to look at. I can tell you that the more often that people pay attention to those websites, those resources, they tend to want to make changes, and oftentimes the changes that they want to make are not in their best interest. They really would be very, very risky or very ill-timed. So definitely need to understand that having some human guidance is not something that a robo solution would do for you. Brokerage firms are another one that would be typical. A registered representative, which both Luke and I are registered representatives. We still hold that securities license, but very little of our business anymore goes into that. It's mainly just to service the existing clients that we've got that still have brokerage accounts. Those would tend to be accounts that would have commission-oriented arrangements. In other words, something that you would pay up front or would have included in the investment itself. So we still hold those legacy assets, but for the most part, we are not charging commissions to investors. Once in a while, it can be in your best interest. It can be actually cheaper to do that, but in most cases, we don't go on that side of it. What I think of as a traditional brokerage firm, though, would be a Merrill Lynch or a UBS, for example. These would be what we would call wirehouses. A wirehouse being where somebody actually works for that firm, and typically they would have proprietary products. They would have revenue sharing agreements. They would have sales quotas. So there could be a lot of things that that person is being influenced by that, again, may not be in your best interest, but they could be influenced by because they have a larger company that is requiring them to act or recommend in certain ways. So pretty important to understand that if an advisor is working for a big wirehouse firm like that and they're not independent, they could be swayed by different things. There could be some things that you may not know about that would be influencing their decisions and their recommendations. Advisory firms, that's primarily how we do business. So advisory services are provided on a fee basis. It means that you see it, you're paying it, it's coming out of your account, it's line itemed on a statement, so you would see exactly what that was. They're definitely disclosed, so there's a fee schedule, there's a written agreement. This is, I think, the best way to do business, simply because it gives you the peace of mind of knowing exactly what it is that you're paying, you know exactly what it is that you're getting, and that transparency now allows you to make better decisions. Just like if you were going to go out and buy anything, any kind of a service or a product, you would want to know how much it's going to cost and what am I going to get for that cost. So advisory, I think, works out really, really well for that. Approximately 85% of our firm now is an advisory. And again, most of the brokerage assets that we hold on the books are still held for mainly just because it may be some products that people bought years ago, or maybe they bought at a different firm, and they're still an appropriate investment for the person to hang on to at this point. Advisory services can, the firms that you're working with can vary in size. Right now, Keystone Financial is roughly $140 million in assets under management, which locally makes us pretty large. Nationally, there are firms that have over $1 billion or even multiple billions of assets under management, so there can be a lot of scale differences there. it's something to think about, because if you are working with a really small firm, they may not have the resources to be able to give you what you need. But if they're too big, then there may not be that personalization. There may not be that relationship that you want. So it's important to kind of marry that up with what your expectations are and the people that you're really working with. So taking a look between the two, there's a lot of different things that are involved between the two, but the expenses really are key. Expenses between what you would get at a brokerage firm versus paying advisory fees. Basically, it's commissions versus fees. It's two different ways of paying. Commissions would tend to be fairly inexpensive if somebody just had a complete set it and forget it portfolio where they just bought something and never invested again. And maybe that was the best thing, right? There could have been something that did really well over time and never needed to be adjusted. I think we know that the reality is that changes do happen in your life and in the market, the economy, and what other investments are available. So basically, it allows the person that's giving you advice to be able to tell you to leave your investments alone if that's the best thing, or to make changes if that's the best thing, because they're not being financially incented to make changes. As you can imagine, years ago when the industry was more commission-oriented, well, those conflicts of interest existed, didn't they? Where you never really would know for sure if somebody was making recommendations so they could get paid again, or was it because it was the best thing for you? So I think it really ends up being a much better thing on the side of the consumer in most cases to be working with an advisory firm. Advantage of relationship, basically I think the biggest thing here is looking at the fact that that advisor or that firm is going to be more closely aligned with what it is that's appropriate for you. They're going to know you. They're actually required to know you legally. They're required to know you and to be keeping track of your financial situation, but also to be able to be more focused on goals and really what your family is trying to accomplish, focusing on risk, things that may not have anything to do with whether one fund did better than the other, or whether it would be better for somebody to get paid again. Again, there could be some disadvantages to a brokerage relationship that definitely tilt advisory being the better thing. So, obviously, this isn't a commercial necessarily for us. It's full disclosure. We are in this business, but the value of a fiduciary is that it is going to be the highest standard. If you're going out and trying to find somebody to work with, you want to be finding somebody who's a fiduciary that has that legal requirement. Certified financial planner, again, that is going to help you get a far distance along that path, knowing that they hold that designation, that they are considered a fiduciary just by that arrangement, and that doesn't matter what company that they work for. But because they're also being paid based off of a fee, you can see that there's some skin in the game, in that you would stop paying them if they aren't doing a good job. You would fire them and they stop getting paid. And as your assets go up and down, they also would participate in that. So that's one risk of our business, is the fact that when the market conditions aren't good, things are going down, and we do feel that, and we also feel the upside as well. So we get to share that pain and get to celebrate as well when things go well. So ultimately, that bottom bullet point I think is key. You can't legislate trust. You can try to. Ultimately, trust is going to have to be between two individuals, and whether there's history there, whether there's competency, whether there's sometimes just people clicking and having some type of a rapport with their background. There's a lot that goes into what creates trust, but the fiduciary standard is going to be a legal requirement that helps to eliminate conflicts of interest and to ensure a higher standard of care. Communication is something that you also should be looking for. We at Keystone Financial try to hyper-communicate. Sometimes people say we communicate too much, but we would try to err on that side. And the reason why we would try to err on that side is that is the number one complaint from clients of their financial advisor, not with us necessarily, but industry-wide. That is the number one reason why somebody says they leave their financial advisor, is that I never hear from them. They don't communicate with me. So I invested all my money, and then that's the last that I heard. We hear that stuff all the time, and to me it just boggles my mind, because that's the fun part of this industry, is the fact that we get to talk, the fact that we get to have a relationship and keep track of each other. So Communication is important. Some of the things that we're doing every time now is anytime a trade goes through, people are made aware of it, and then they see both buy and sell as far as being notified when something happens. So there's no black box where a bunch of stuff is happening and people don't know about it. Having commentary, certainly education is something that we've always focused on, and basically just making sure that we're communicating with clients and helping them understand the marketplace, understand the economy. That's important, because if we don't, then all you're hearing is from the news media, and we know that they're going to be just a bundle of joy of negative information, right? Summaries, videos, fact sheets on the strategies, education. That's what we've been working on for years and years and years, just helping people understand what it is that they need to be focused on so they can make better decisions with our guidance. Got a question from Alan. He said, how are advisors held to the standards? Are there audits or something of that nature? Yes, there actually are. So the Securities and Exchange Commission is the primary regulatory body that regulates advisors, and they also, as part of that, of course, they have different rules. They will put different things in place. For example, the fact that we actually have to document at least annually, and yeah, I would admit this is a low bar, but that we have to document at least annually that we have gone through, had discussions with the client, we've reviewed performance, we've reviewed all their financial information, we've reviewed everything pertaining to their financial plan. So that's something that we are legally required to do on an annual basis. How do they get caught? The people that don't do that, well, they do get audited. And so firms, including ours, do get audited on a routine basis, typically once per year. I would say either an internal audit that we end up having or actual regulators coming in and taking a look. There actually are state regulators as well, and there are the federal regulators. So both sides actually have the right to be able to do an audit. Those can be surprise audits. They can just show up if they want to. So there are ways that people are regulated. Sometimes those are electronic audits too, just looking at our systems electronically to see if we've documented for every client. So yeah, there definitely are standards, and there are audits to make sure that this stuff is happening. Asking the right questions, oftentimes this ends up being really the key, is asking the right questions so you can get people talking, and the same thing would be with an advisor, is hearing what they have to say about their compensation. That would be the number one question I would ask, is how do you get paid, basically. It would be rude to ask them how much they get paid, right? Their personal compensation, but it's not rude to say, how do you get paid? How do I pay? What are my costs? That should be just a standard question, and you shouldn't have to feel bad about that at all. In fact, if an advisor shies away from that question and gets uncomfortable, that's a warning sign, I think, that may not be who you want to be working with. In other words, if you're not getting a straight answer from them, then that could be a concern. That could be a concern that you're not going to get the transparency that you deserve. Other questions, if they are commissions, how is that paid? How do you eliminate conflicts of interest with that? If you get paid every time that I trade or make changes, do they have any choice? Do you have a choice of working on a fee? I can tell you, if it was my mom, if it was my aunt, people in my family, I would always be recommending that they work with a fiduciary advisor and do it by fee, not by commission, because it would make me feel a lot better, the fact that we are all able to see then how their accounts are performing, what they're paying, where their money is invested. Lots of questions about fees. Are there other fees? Are there things that you haven't mentioned already? Do you have a minimum account balance fee? Do you have custodial fees? These are all important things that you should be aware of, because fees can add up, even if they're little. You look at that slide earlier on that has the list of mutual fund fees. That stuff does add up. And ultimately, I tried to stick to my half hour, by the way. Ultimately, it really comes down to the humans that you're dealing with, and our team really is committed to not only fulfilling that fiduciary standard and having our clients feel good about that we are upholding that highest standard, but the fact that we really do get to know you. We get to know your family. We get to know your situation. We get to know exactly what it is that you're trying to accomplish individually, because if we don't, then we're really not doing our job, and we don't become a whole lot different than those robo advisors, those things that you could just do online without having humans involved. Clearly, if you don't have humans involved, it's always going to be cheaper, but it's not always going to be the best quality, and you might not always make the best decisions. So I would actually argue it a bit that you could go online right now and find a YouTube video on how to do just about anything. I could fix my furnace if I wanted to by going on and looking at enough YouTube videos. But chances are, because first of all, I'm not handy, so you probably don't want me fixing your furnace, and you probably don't want me fixing mine. I probably would not do a very good job at it. I probably would take forever, so then you add up the amount of time and additional gray hairs, that I would get in the process. Who knows? Maybe I could actually accomplish it. Maybe it will be something that I could do if I spend enough time at it. But in this life, we only have so many hours in the day, and you've got to figure out, what do I want to do with my time? Because that's the one thing you can never get back, is time. And that's one thing that not only we buy for people, by them not having to spend time on becoming a financial planning expert, but the fact that we can help them make better decisions with their money, because we've got experience with hundreds and hundreds of client meetings. I've done thousands of between presentations, one-on-one client meetings over the years, so I understand human behavior, I understand financial behavior, I understand what happens in different types of markets and different types of things that people tend to do that can go wrong, that really can have a lifetime of pain financially if you make the wrong move at the wrong time. So one thing I noticed on here, by the way, is that our email is communications@keystonefinancial.org. We missed a K in there, so it's communications@keystonefinancial.org. And as we wrap up here, I know we've got a couple other questions that are in the queue, so I'll answer those. But I did want to point out that we are doing these fairly frequently. We're using online communication, not because we don't want to see you, but because we actually want to make this really convenient for you, especially for those of you who may not be right next door to our office. Even if you're at work right now, you could be 10 minutes away. It may be just much more convenient for you to listen this way and be able to listen to a replay. So we will be uploading this to our YouTube channel afterwards. And our YouTube channel, I'll pull over our website so you can see. We have social media links at the top of our website, and this YouTube channel here on the far right-hand side. That would be something that you would want to subscribe to or visit if you wanted to send a recording of this presentation on to one of your friends, coworkers, if you think that they would have benefited from listening today. You can also connect with us on Facebook, LinkedIn, Twitter. We speak all those languages, and we're communicating with people all those ways. So you may never get on Twitter, and that's fine. We understand that's something that we can speak that language, and we can also speak Facebook, and we can speak email, and we can speak sitting down face-to-face. So we want to make sure that we try to reach you where you're comfortable and make sure that we are getting all the information out to you that you need. The other thing I wanted to point out is we have another presentation coming up. The Social Security Medicare topic actually will be an in-office topic on Wednesday the 26th. That's next Wednesday, and we have two times, noon and 5:30, both Mountain Time. So you can RSVP for that out on our website under menu and about and events. You can click out there or just email us back to that email address, to keystonefinancial.org. That will be the communications@keystonefinancial.org. We will also send you a white paper if you sign up for our newsletter. So back to the Keystone Financial site, if you scroll all the way to the bottom, there's going to be a subscribe to our commentary and blog. If you put in your name, your first, last name, your email address, and your phone number, what that will allow us to do is stay in touch with you. And as we have stuff like we've done today come up in the future, we'll make sure we communicate that to you. But by submitting that, we will send you our white paper that gets into more detail about the presentation today, gets into more detail as far as the types of expenses and how you determine those or know even what to ask. All right. Just for kicks, we'll put me back on. Let's take a look at what else we have for questions here. Looks like, let's see, Alan says, when we use tools like Orion, how do we know if the real return reflects the return after expenses that have been taken into account? Great question. So whether it's using our software or somebody else's software, when you see a rate of return actually illustrated an audited rate of return, and that relates to the software I mentioned before that we use, our technology called Client Experience Optimizer, that actually allows our clients to see on a day-to-day basis what their expenses are, and they can see exactly what the returns are. And the return that's illustrated on there is net of expenses. It's after expenses have been taken out. That's the actual return that you've gotten. So very, very good question. I would always ask that because I can't vouch for anybody else's software or technology, but I can tell you that the returns that we put out there are net of expenses. So you can see what the cost, what the real return was after the cost has been taken out. Joe says, where can we find the fees associated with our individual investments other than contacting Keystone? Again, that would be back to Client Experience Optimizer. If you go to our website, I'll actually pop that back up. You can see on our top page here, it says Client Logins. And then our Client Logins, there's going to be all these different links down here. The ones that you want to look at are these first two. Wealth Management System, which is a really robust personal financial website that we build out for you when you're a client, and then Client Experience Optimizer, which really allows you to go in and see exactly what those costs are inside your investments. So that would be the one that you'd want to get access to. It would be Client Experience Optimizer. Should be noted that the fees and expenses for advisory accounts are the ones that are actively disclosed and available for you to see. In other words, your expenses for brokerage type products that may be legacy type assets, those would not show up as a line item because they're built into that product themselves. So that's a big difference between brokerage and advisory. Again, if you've owned brokerage assets, then that will not show up when we show all the fees and expenses because of the lack of transparency on those types of investments. So then, yes, you would need to contact us, and then we can dig into prospectuses or wherever we need to go. What else? What else do we have for questions today? Anybody have other questions? I always makes me laugh when I ask that because I had a college professor that he, at the end of about every 5 minutes or so, he would say, does anybody have any comments or questions or reactions? So I'll never forget that. I can't even remember exactly what the name of the class was, but I'll never forget that. I hope if you do have comments, questions, or reactions, you contact us directly here at the firm. The best way to reach us is that communications@keystonefinancial.org address. That will make sure that the message gets to the right people. You can also call us, you can visit us, you can go to our social media sites. Again, we want to be, if anything, hyper-communicative in that if we are not reaching out to you, if you're not hearing from us, then that's not a good sign. You should be able to get in contact with us, whether it's virtual or face-to-face. So that's an expectation that you should have of us as a firm and any advisor that you would work with. So with that, I'm going to wrap up the webinar today. Thank you very much for attending. I've really appreciated being able to spend the time with you today. We try to get these done quickly too and try to get as much information as we can into a short amount of time because, again, your time's valuable and you'll never get it back. So we want to make sure that anything that we are communicating with you on is good information and stuff that you can take action on. Thank you very much. Thanks for your business. Thanks for your time today. Please join us on our next webinar, which will continue to be advertised on our social media sites. And if you're on our email list, we will definitely let you know about that. Please let us know very soon if we can help you and your family. Take care.